Have you ever wondered why so many traders fail, while a select few seem to consistently profit regardless of market conditions? The difference isn't luck, insider knowledge, or even intelligence. It's understanding a set of timeless principles that have governed markets since their inception. Today, we're diving into the wisdom of one of history's greatest traders, Jesse Livermore, whose insights remain astonishingly relevant in today's fast-paced digital markets. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You enter a trade based on a hot tip or a compelling news story, only to watch the market immediately move against your position. Or perhaps you've experienced the frustration of selling a winning position too early, only to see it continue climbing for days or weeks afterward. These painful experiences aren't random. They're the predictable result of ignoring the market's own language. The market never lies. This might sound like a bold claim in a world where manipulation, fake news, and conflicting opinions dominate financial media. But beneath all the noise and chaos, the market's movements reveal profound truths about human psychology. While analysts, tipsters, and so-called experts can and do mislead, the price action itself, the actual movement of capital, always tells the truth to those who know how to listen. Stay with me until the end of this video, because what you're about to discover might transform not just how you trade, but how you understand the psychological patterns that drive all markets. These aren't merely techniques, they're insights into human nature itself. The first and perhaps most challenging principle to master is patience. In an era of instant gratification, where algorithms execute trades in milliseconds and social media bombards us with constant opportunities, the ability to wait has become a rare and precious skill. Most traders cannot resist the urge for action, treating markets like casinos rather than the complex mechanisms they truly are. They jump in and out impulsively, driven by emotions rather than logic. What's fascinating is that this very impatience creates the opportunities that patient traders exploit. When the crowd rushes in, driven by FOMO or panic, the disciplined trader waits. This isn't passive inaction, it's strategic positioning. It's the difference between being the casino or the gambler, between being the predator or the prey in the financial ecosystem. Think about your own trading history for a moment. How often have your best decisions come from acting quickly versus waiting for the perfect setup? How many times have hasty entries cost you dearly? The transformation in your trading results begins the moment you embrace another fundamental principle: cutting losses quickly while letting profits run. This seemingly simple rule reveals a profound truth about our psychological makeup. We humans are wired to avoid pain and seek pleasure, which paradoxically leads us to hold on to losing trades far longer than we should, while snatching quick profits before they've had time to truly develop. If you've found value in these timeless trading principles, hit that subscribe button to join our community of disciplined traders. Each video unpacks market wisdom that has stood the test of time, helping you develop the patience and clarity needed for consistent success. Think about the hidden truth behind your last 10 trades. Did you find yourself watching a losing position, hoping it would turn around, creating elaborate stories about why the market would eventually prove you right? Meanwhile, when a trade moved in your favor, did you feel that irresistible urge to lock in profits quickly, afraid they might vanish? This mindset creates a devastating imbalance, small wins that barely cover commissions paired with losses that grow exponentially as you refuse to admit a mistake. The journey toward mastery requires a complete reversal of these instincts. The disciplined trader accepts small losses as the cost of doing business, a decision that preserves capital and mental energy for better opportunities. Simultaneously, they allow winning positions the space to breathe and develop, often resulting in gains that dwarf the small, quick profits that satisfy the amateur. This principle connects directly to another revelation that shapes every successful trader's approach: following the trend. Behind the scenes of every major market movement lies a powerful current, the path of least resistance that carries prices in a persistent direction. Fighting this current is exhausting and usually futile, yet most traders spend their careers attempting to pick tops and bottoms, believing the myth that greatest profits come from catching exact turning points. The impact of this misunderstanding is devastating to trading accounts. While the crowd fights the trend, hoping to be the hero who called the exact reversal, the disciplined trader simply aligns with the existing momentum. They don't need to know where the top or bottom will be. They only need to recognize the direction of the prevailing wind and set their sails accordingly. What's fascinating is how these principles reflect broader life truths. Just as we resist cutting our losses in relationships, careers, or business ventures that clearly aren't working, we often fail to fully commit to the positive trends that could carry us to greater heights. Our attachments to past decisions cloud our ability to see the market and life as it truly is, not as we wish it to be. Now, I want to go even deeper into this topic by examining how successful traders actually implement these principles in real market conditions. The practical application reveals subtleties that make all the difference between theoretical understanding and profitable execution. But before I continue, I'm curious, has this resonated with your own trading experiences? Write market truth in the comments if you've noticed these psychological patterns in your own decision-making. The revelations continue when we explore what truly moves markets. In an era where financial news bombards us 24/7 and social media gurus share hot tips by the minute, there's a profound wisdom in turning down the volume and focusing on the only signal that matters, the price action itself. The tape, that continuous record of actual transactions, is the ultimate truth-teller in a landscape filled with distractions. This mindset shift represents one of the most liberating moments in a trader's journey. Imagine the clarity that comes when you stop chasing rumors, stop hanging on every word from financial pundits, and instead develop the discipline to watch what the market is actually doing. Behind every price movement lies the reality of supply and demand, the genuine expression of fear and greed playing out in real time. I've witnessed countless traders who consume financial news obsessively, who join exclusive groups promising insider information, yet consistently lose money. Why? Because they're listening to stories rather than observing actions. The market doesn't care about narratives. It cares only about the collective decisions of buyers and sellers, which are perfectly reflected in price. This understanding connects directly to perhaps the most powerful insight of all: human nature never changes. The greatest illusion in finance is that each market day brings something entirely new and unprecedented. In reality, only the actors and specific circumstances change, while the underlying psychological drama remains remarkably consistent throughout history. From the tulip mania of the 1600s to the cryptocurrency booms and busts of recent years, the same patterns of excessive optimism followed by despair repeat with astonishing reliability. This constancy exists because markets are ultimately just mirrors reflecting human emotions. Our collective hopes, fears, and biases crystallized into price movements. Chart formations that worked for traders a century ago continue to work today because they capture the unchanging essence of crowd psychology, the public's tendency to chase, performance, to buy high and sell low, to seek confirmation rather than contradiction. These behaviors create the very opportunities that disciplined traders exploit. What's fascinating about this perspective is how it transforms market analysis from complex forecasting into pattern recognition. Instead of trying to predict the unpredictable future, successful traders learn to identify the familiar footprints of human behavior that have appeared throughout market history. They recognize the signs of euphoria near tops and capitulation near bottoms. Ready to transform your trading through these proven principles? Subscribe now to continue your journey with us as we explore the psychological patterns that drive all markets. New insights await you with every video we share. This understanding brings a profound calm to your trading. When you realize that nothing happening today is truly unprecedented in psychological terms, you stop reacting to each headline as though it's revolutionary. You develop patience, waiting for the patterns that have historically provided the best risk-to-reward ratios. The enlightenment comes in recognizing that we ourselves are subject to these same psychological tendencies. Our impulse to follow the crowd, our reluctance to admit mistakes, our tendency to see what we want to see rather than what is. These are the very behaviors that create market inefficiencies. Now I'm going to share how awareness of these patterns allows us to not only avoid their pitfalls, but to benefit from them systematically. If you've experienced these psychological battles in your own trading, type pattern aware in the comments below. This predictability of public behavior creates a roadmap for the disciplined trader who understands market psychology. Think about the last major market move you witnessed. Did you notice how in the early stages, when prices first began to rise, few people were interested? Then, as the advance continued, media coverage increased. More investors jumped in, and eventually, near the top, even the most skeptical participants couldn't resist the fear of missing out. This crescendo of enthusiasm marks the moment when virtually everyone who could buy has bought, the perfect setup for a reversal. The revelation here is that this sequence isn't random. It's a natural expression of human psychology playing out in the marketplace. What makes this insight so powerful is that once you recognize the pattern, you can position yourself against the crowd at pivotal moments. While the public rushes in during the final stages of an advance, the disciplined trader is already looking for signs of exhaustion. While the public sells in despair during deep declines, throwing away valuable assets at bargain prices, the knowledgeable investor begins accumulating. This understanding leads to a profound mindset shift. Successful trading isn't about predicting the future, it's about recognizing the present moment within these recurring cycles of fear and greed. It's about developing the inner awareness to ask yourself, where in this emotional cycle are we right now, and how does that influence my decision-making? The journey toward trading mastery ultimately reveals itself as a path of self-mastery. Behind the scenes of every successful trading career lies not some brilliant mathematical formula or secret indicator, but the development of exceptional self-discipline. As Jesse Livermore himself famously observed, "It was never my thinking that made big money for me, it was always my sitting." This statement encapsulates a truth that contradicts almost everything in our action-oriented culture. Sometimes the most powerful thing you can do is nothing. This patience requires a transformation that few are willing to undertake. In a world that celebrates constant activity, that equates busyness with importance, the ability to sit quietly and wait for ideal conditions feels almost revolutionary. Yet, the greatest traders throughout history have emphasized this same quality, not brilliant analysis or complex systems, but the temperament to observe patiently and act decisively only when the odds are clearly in their favor. Consider how this applies beyond trading. In almost every domain of life, from relationships to career decisions, we often feel compelled to act immediately, to do something when faced with uncertainty. Yet the most consequential decisions often benefit from precisely the opposite approach. Careful observation, pattern recognition, and action only when conditions truly warrant it. This self-mastery creates a remarkable competitive advantage. While most market participants are driven by emotional reactions, constantly responding to the latest news or price movement, the disciplined trader maintains perspective. They understand that most market noise is irrelevant to long-term success, and that genuine opportunities appear relatively rarely. They've developed the wisdom to distinguish between action for action's sake and action that genuinely serves their strategy. If you recognize this distinction between meaningful patience and mere inactivity in your own experience, type strategic patience in the comments. Understanding market dynamics requires recognizing a fundamental principle that governs all price movements: the law of action and reaction. Just as in physics, every market advance must eventually experience some form of pullback or consolidation. This natural rhythm reveals profound insights about the underlying strength or weakness of a trend when you learn to interpret it correctly. The enlightenment comes when you realize these reactions aren't random noise. They're diagnostic tools that reveal the health of the primary movement. When a stock advances rapidly and then experiences only a shallow pullback before resuming its upward march with renewed vigor, you're witnessing the signature of genuine strength. Conversely, when a decline is followed by a weak, struggling recovery that fails to gain momentum, you're seeing the footprints of persistent weakness. This understanding transforms how you view price charts. Instead of seeing random zigzags, you begin to recognize the breathing pattern of the market, its inhales and exhales, each telling you something vital about what might come next. The catalyst for this shift in perception isn't some complex algorithm. It's simply developing the awareness to observe how the market behaves after a significant move. What's fascinating is how few traders develop this awareness. They become fixated on individual price bars or candles, missing the broader rhythm that could tell them whether they're swimming with or against the tide. It's like focusing on individual trees while missing the patterns of the forest. This perspective naturally leads to another revelation that separates amateur traders from professionals: understanding where the real money is made. The breakthrough moment in many trading careers arrives when you realize that genuine wealth doesn't come from constantly scalping small moves. It comes from identifying and riding major trends. The psychology behind this insight is counterintuitive in our culture of instant gratification. The scalper experiences frequent small wins, creating a steady stream of dopamine hits that feel satisfying. Yet paradoxically, many end their careers with minimal net profits despite enormous effort. Meanwhile, the trader who focuses on capturing significant portions of major moves while experiencing fewer but larger wins often achieves life-changing returns. This paradox highlights a fundamental journey of transformation that every serious trader must undertake. We must unlearn the desire for constant action and feedback, replacing it with the discipline to wait patiently for those rare moments when all factors align for a major move. When such alignment occurs, the professional trader doesn't just take a small position. They commit meaningful capital and add to winning positions as the trend confirms itself. Behind the scenes of every great trading fortune lies this principle of concentration rather than diversification of effort. As Livermore himself observed, the big money isn't made in the daily fluctuations, but in the major swings that might only occur a handful of times each year. The disciplined trader conserves capital, energy, and emotional resources for these moments rather than depleting them on insignificant price movements. This approach demands a remarkable shift in mindset, from seeking constant activity to cultivating strategic patience, from demanding daily feedback to embracing the uncertainty of larger timeframes. It's a journey few complete, but those who do discover a different relationship with both markets and time itself. If this distinction between meaningful trends and market noise resonates with your experience, type "Big moves matter" in the comments. The wisdom of the market reveals itself most clearly when we compare two fundamentally different approaches to decision-making, following established rules versus acting on hunches. This distinction represents a pivotal crossroads in the evolution of every trader's journey. While hunches, those gut feelings or intuitive leaps, can occasionally yield spectacular results, they lack the consistency that builds fortunes over time. The revelation that transforms amateur speculators into professional traders is the understanding that predictability emerges from discipline, not inspiration. Behind every successful trading career lies not a series of brilliant guesses, but a methodical application of time-tested principles. This shift in perspective represents one of the most profound mindset transformations possible. From seeing the market as a mysterious force that occasionally rewards the lucky, to recognizing it as a complex but ultimately rule-governed system that consistently rewards the disciplined. What makes this insight so powerful is how it liberates you from the emotional roller coaster of trading. When you operate on hunches, each trade carries the weight of your ego. It becomes a referendum on your personal cleverness or intuition. But when you operate according to rules, the outcome of any single trade becomes less personal. You're simply executing a system that you know works over time, even though it will inevitably produce occasional losses. The hidden truth here is that rules-based trading isn't just more profitable, it's also more psychologically sustainable. The trader who relies on hunches experiences wild swings of confidence and doubt. The trader who follows rules experiences the steady certainty that comes from aligning with principles larger than themselves. They understand that predictability emerges not from forecasting any specific event, but from recognizing the repeated behaviors that create similar opportunities across different eras and markets. Now I want to go even deeper into this topic by exploring what might be the most counterintuitive insight of all. Patience is actually harder than courage. Most of us imagine that the greatest challenge in trading is having the nerve to enter a position, to risk real money on an uncertain outcome. And yes, that does require a certain fortitude. But the real test, the one that separates the professionals from the amateurs, is the patience to wait for perfect conditions. This perspective represents a complete reversal of conventional wisdom. In our action-oriented culture, we celebrate decisive movement, bold risk-taking, and quick execution. Yet in the realm of trading, these very qualities often lead to disaster. The truly difficult work happens in those long stretches between optimal setups, when prices drift without clear direction, when the tape offers no compelling signal. During these periods, which constitute the vast majority of market time, the disciplined trader does nothing. And make no mistake, this nothing is not passive. It is active restraint, conscious discipline, the deliberate conservation of capital and emotional energy. It is the trader sitting at their desk, studying the market with full attention, yet refusing to act until the conditions align precisely with their criteria. This stillness represents perhaps the most challenging form of self-mastery possible in a world that constantly demands action. The breakthrough moment comes when you realize that courage is required only briefly at the moment of execution, while patience must be sustained hour after hour, day after day, sometimes for weeks on end. The recognition of this truth doesn't just change how you trade, it transforms how you relate to time itself and to your own impulses. Have you experienced this tension between action and restraint in your own trading? Type disciplined waiting in the comments if you've felt the challenge of patience firsthand. Now, I want to go even deeper into this topic by exploring one of the most powerful skills any trader can develop, the ability to recognize the subtle footprints of accumulation and distribution in the market. This insight illuminates what's happening beneath the surface, revealing the invisible hands that truly drive price movements. The revelation that transforms ordinary chart reading into genuine market wisdom is understanding that large operators never move all at once. They simply can't. When institutional investors or smart money decide to build a significant position, they must accumulate shares gradually over time. Similarly, when they decide to exit, they must distribute their holdings carefully to avoid crushing the price. This necessary patience creates distinctive patterns, footprints that appear in price action and volume for those who know what to look for. During accumulation, a fascinating transformation occurs in how a stock behaves. It develops a stubborn resilience, refusing to break down even when the broader market weakens. Each decline finds mysterious support, as though invisible hands are quietly gathering shares whenever prices dip to attractive levels. The most enlightening aspect of this process is its contradictory nature. While accumulation is happening, often the most profitable time to buy, the stock appears utterly boring to most observers. Volume may be moderate, price movement restricted, news flow minimal. The crowd, always hungry for excitement, looks elsewhere, completely missing the behind-the-scenes work being done by patient, disciplined operators building positions for the eventual move upward. Distribution follows the same principle in reverse, but with a crucial psychological difference. As prices rise and the public becomes increasingly enthusiastic, smart money begins feeding their accumulated shares into this growing demand. The footprints appear as increased volume on rallies, diminishing momentum despite good news, and sharper reactions on any decline. The stock struggles to make new highs even as optimism reaches fever pitch. The tragic journey of most investors is that they completely misread these signals. They ignore stocks during the quiet accumulation phase, only becoming interested after prices have already advanced significantly. Then, seduced by rising prices and glowing headlines, they buy enthusiastically during distribution, precisely when smart money is exiting. This pattern has repeated across centuries, markets and assets, because it reflects unchanging human psychology. The transformative insight comes when you realize these footprints aren't mysterious or accessible only to insiders. They're written clearly in the price action itself for anyone willing to study with patience and objectivity. The successful operator develops an almost artistic sensitivity to these subtle patterns, learning to distinguish between genuine accumulation and mere temporary support, between calculated distribution and normal profit-taking. This awareness represents a profound mindset shift from being part of the emotional crowd to becoming a clinical observer of market psychology. Instead of being swept up in the narratives that justify price movements after they've occurred, you begin to recognize the actual process of strong hands quietly building positions before any obvious news catalyst appears. What's truly enlightening is how this skill applies beyond markets to almost every domain where influence operates behind the scenes. The ability to detect subtle changes before they become obvious to the majority represents perhaps the most valuable form of perception in business, politics, and life itself. If you've noticed these patterns of quiet accumulation before a major move in your own market observations, type hidden hands in the comments. Now, I want to go even deeper into this topic by exploring the fundamental mechanism that drives all market movements, the eternal dance of supply and demand. When we strip away all the complexity, all the technical indicators, and all the financial jargon, we discover that markets ultimately respond to this single powerful dynamic. Understanding how this mechanism manifests during different market phases provides extraordinary clarity in an otherwise chaotic environment. The illumination comes when you recognize what physically happens during accumulation. As strong hands patiently absorb available stock, the floating supply, shares available for trading, gradually dwindles. This creates a fascinating market physics problem. When genuine demand eventually arrives, there simply isn't enough supply to satisfy it without sharply higher prices. The result is often an explosive move that surprises everyone except those who recognize the diminishing supply beforehand. This process creates one of the most profound asymmetries in financial markets. A stock that has been under quiet accumulation for months can suddenly advance more in weeks, or even days, than it did during the entire base-building period. The catalyst for such moves is rarely some unpredictable news event, but rather the inevitable consequence of supply-demand imbalance created during accumulation. The mirror image occurs during distribution. As stock is gradually fed to eager public buyers, available supply grows increasingly heavy. The watershed moment arrives when demand finally weakens, perhaps due to broader market concerns or simply because everyone who wanted to buy has already bought. With no more eager hands to receive the remaining supply, prices collapse, often with a violence that mirrors the earlier advance. The revelation here is that market cycles aren't random or mysterious. They're the predictable outcome of how large positions must be built and unwound. This understanding transforms how you interpret price movements, helping you see beyond the daily noise to the underlying process that determines long-term direction. The journey toward trading mastery culminates in perhaps the most difficult lesson of all. Tips and rumors are poison. This represents the ultimate paradigm shift because it contradicts our natural human tendency to value insider information and special knowledge. We're biologically wired to perk up when someone whispers a secret, to feel privileged when offered seemingly exclusive insight. Yet this very instinct leads countless traders to ruin. The breakthrough moment arrives when you realize that tips, even from seemingly knowledgeable sources, represent nothing more than opinions, usually second-hand and often tainted by self-interest. They create dependency, undermining your judgment and self-reliance while distracting you from the one source that never lies, the tape itself. What makes this insight so liberating is how it simplifies your decision-making process. Instead of chasing rumors or hanging on the words of supposed experts, you focus entirely on what the market is actually doing. You observe what insiders are doing rather than what they're saying. Their words may deceive, but their actions, recorded faithfully in price and volume, cannot hide the truth. This principle applies far beyond trading, touching on a universal wisdom about human nature. In almost every domain, actions reveal more than words ever could. If you've experienced the clarity that comes from focusing on what people do rather than what they say, type "actions truth" in the comments. As we've explored these timeless trading principles together, I hope you've recognized something profound. These aren't just techniques for financial markets, but insights into human nature itself. The patient discipline that makes a great trader often creates excellence in every domain of life. The ability to read beneath the surface, to recognize patterns others miss, to maintain independence of thought when the crowd rushes in one direction, these are the qualities that create not just financial success, but wisdom. I share these ideas not because they're easy to implement, they're not, but because they represent a path of genuine transformation. The journey from impulsive action to strategic patience, from chasing tips to trusting your own analysis, from seeking constant excitement to embracing meaningful opportunity. This is the evolution that separates those who consistently succeed from those who merely participate. If you've found value in these insights, consider subscribing to join our community of thoughtful traders and investors. Each week, we explore these principles in greater depth, examining how they apply to current market conditions and psychological challenges. Your subscription helps us continue creating content that cuts through the noise to focus on what truly matters. If something in this video resonated with you personally, I'd love to hear which principle struck the deepest chord. Leave a comment with market wisdom, followed by the insight that meant the most to you. Your perspective enriches our collective understanding. A simple like on this video helps others discover these principles that have stood the test of time. Principles that are often drowned out in a world obsessed with quick results and easy answers. I've prepared a video right here that dives deeper into the practical application of these rules in today's markets. Click to continue exploring how these timeless insights can be translated into specific trading strategies that work in our modern financial landscape.